PepsiCo is down 8% over the last 12 months. It looks to be extremely undervalued with some nice upside. We can see all three analysts are indicating it as a buy now, Seeking Alpha, Wall Street and quant analysts. So let's find out if this is one that you need in your portfolio. And as always, we will take a deep dive into this company. We're going to look at their revenue growth year on year over the last 10 years, as well as their bottom line net income. We're going to dive into the health of this company, their total cash versus their total debt, and we want to see how strongly they have performed over the last 10 years versus some well-known competitors. We'll also touch upon their dividend safety, dive into a lot of important financial metrics like their free cash flow, and we'll talk about not just insider buys and sells, but also look at the institutions if they are continuing to buy shares of PepsiCo. And importantly, we do want to run through their latest investor presentation, a lot of key things to highlight for you so you are aware of where this company is going in 2024 and beyond. And don't forget, as always, we will run them through the valuation model, getting to our own intrinsic value, finding our acceptable buy price, given our investor margin of safety, and as always, we'll see what Wall Street themselves are forecasting over the next 12 months. So let's dive into the company's historical performance. Now, they are down 8% over the last 12 months. We can see year to date pretty much flat. However, when we extend this to the last 10 years, they are up 97%. Granted, it doesn't include those dividends reinvested, and we can see all-time highs of $196 in May last year, not too far away. Now, in terms of dividend yield, they do currently offer just under 3%, and the forward PE does sit just under 21. And as we mentioned, all three analysts indicating this as a buy. So in terms of looking at their top line revenue growth, what we like to see for a company in Pepsi's position, stable, mature company, we want to see 3 to 7% growth year on year. And what we do notice in 2014, 66.7 billion on their top line, 91.5 billion in their latest annual accounts. So they are growing their top line. What is quite nice to see is over the longer term, it is moving in the right direction. So that is very healthy for this company. And we will look at the percentages shortly as well, so we can understand where they are fitting within our 3 to 7%. Bottom line is what it has been increasing from 6.5 billion in 2014 to just over 9 billion in their latest report. And again, we can see it is moving in that right direction, as we would expect from a company that does increase their top line. In terms of the health of this company, 8.7 billion of cash and equivalents in 2014, 10 billion in their latest account. So they have increased their cash position as well, although we do note it is pretty inconsistent. Over the longer term, though, we do see that growth. Now, how does that compare importantly to their total debt numerically as well as directionally? We can see it has increased from around 29 billion all the way to around 47 over the period. So their cash, as we can see, whilst has increased marginally, their total debt has increased at a much faster rate. And we will factor this in when we do look at that dividend safety and some of those net debt to EBITDA metrics. Now, in terms of looking at their return, we are comparing them to others in the soft drinks and non-alcoholic beverages. Coca-Cola Company, which we did do a deep dive just yesterday, Monster Beverage, Dr. Pepper, and a few others. So this is the total return. It does include those dividends reinvested. PEP is essentially down negative 5.5%, one of the worst performing out of its competitors over the last 12 months. Over the last 5 years, we do see, in fact, they are the second best performing, up 59%, outperforming Coca-Cola as well. And when we expand it over the last 10 years, they are up 162%. Still, however, in the mid-performing of the competitors, but they are above Coca-Cola, which did return under 100%. Now, 162%, not too bad over a 10-year period, but remember that the past performance doesn't mean that they will return this again over the following 10 years. Now, taking a look at some of their growth metrics, what we can see, they got a B- grade. Now, a few things just to pull out from here. Year-on-year growth, just under 6%. Nonetheless, it was above the sector median. Revenue forward-looking, around 4.8%, marginally above the sector at 4.06%. And when we look at the EBITDA growth, as well as the forward-looking, they do outperform the sector median. Now, some things that we don't like from this that we can see here, a C grade for their earnings per share long-term growth rate. What this essentially is over the last 3 to 5 years, year on year, it has increased by 7.7%. Not the worst, but it is a little bit higher for the sector median, hence why they did get that C grade. So overall, some very mediocre grading, hence why they do get the B- final grade. When we do take a look at profitability, a little bit of a different story. A+, we do see their gross profit very strong, over 50%, with the sector median coming in around 35%. Bottom line as well, very healthy, just under 10% above, as we can see here, the bottom line net income margin of the sector at 5%. So we do note their profitability is looking very strong and very healthy. Now, before we dive into some of their metrics and the dividend safety, just to make you aware, they have 0.14% insider ownership. Now, we see 8 million worth of sales by these insiders over the last 12 months. Now, what we want to point out from here are just those who are selling, and we can see the more recent sell is the CFO. We have to go back quite some way now, as we can see here, the 10th of November, who did sell just over 48,000 shares for a total of $8 million. Now, a little bit irrelevant given how long ago this was, but what we would typically say is insider buying is bullish, as insiders buy because they believe the share price will go up. Insider selling, on the other hand, whether they sell, it is something we're not really too sure for the reason. It could be personal or financial reasons, so we wouldn't typically say it is a bearish signal. Now, when we take a look at insider ownership, or in fact institutional ownership now at 73%, we do note some institutional outflows of 26 billion over the period, and during the same period we see a lot more buying by these institutions, 125 versus 25. Now, in Q4, we have the full data set. There was a lot more buying than selling. In Q1 of 2024, we do see 182 million worth of buys versus 55 million worth of sales. So we do note no real insider buys or sales in FY24. And in terms of FY24, institutions are still buying more shares of PEP than they are selling. Always do your own due diligence, so never copy the institutions or insiders. Just to let you know as well, we have released our latest free weekly article. We do run through 10 undervalued dividend stocks. This is based on dividend yield theory as well as a forward P lower than the 5-year average, so a double sign of undervaluation. Free access to this as well as all our other articles. Do click on that pinned comment below and you can get instant access and start reading. Now, we wanted to point out a few slides from the latest investor presentation deck that they gave at a conference in February 2024 that we thought were quite interesting to note. Now, first, this is more of a fact basis in terms of their net revenues at 91 billion. Let me know if this surprised you, but what we can see, in fact, convenient food does make up a larger portion of PepsiCo's revenue than it does in terms of beverage. In fact, beverage did come significantly lower at 38 billion, making up only 41% versus the convenient food of 59%. So that was something I thought was interesting that I would share with you today. Do let me know what your thoughts are on that and if that surprises you. Now, in terms of growth by the actual revenue category, very strong. What this points out, if we start with the left side, is that 2016 to 2018, the average increase over that 3-year period was 2% year on year to their beverages. When we compare that to their convenient food, it was 5%. Now, over the last 4 years, 2019, 2023, we see that they have been increasing at a much higher rate, 7% for beverages, and in fact double digits for global convenient food. So they have been increasing their top line at a faster rate for these two segments, which is very strong, especially if that is to continue. And by actual brand, if you're interested to see which the better brands are at increasing their top line, we do in fact see Doritos up 16%, and we see Cheetos up 14%, making their top two best growth drivers to their top line. But we also see others like Gatorade, Pepsi itself, Mountain Dew, and Lay's all being very strong performers for this company. Then when we take a look at the same information, however geographically, what we can see on the left side is that from 2018 to 2023, they have increased their top line by around 26 billion. Again, as we can note here, very, very strong performance on their growth. And if you're interested to know by region, we do know, in fact, the North America region does lag in terms of growth versus international. In fact, 2016 to 2018, 1.5%. In the more recent last 4 years at 7%, whilst like for international, we see 6%, which was already pretty high. International now 10%. So lots of growth, not just by income stream, but also essentially by region as well that we are seeing over the last few years. Now, in terms of their growth targets forward looking, 2021, 2022, and 2023, on average, their top line has increased by 11%. What they're saying is their long-term target for this is in actual fact 4 to 6%. So they have been doing it at a much higher rate. They are expecting, I believe, this to come down to the mid-single digits. But overall, over the last few years, they have had some tremendous performance. When we look at the same information but for their earnings per share, over the last few years, strong double-digit increases to 12%. Again, for the long-term target, they are expecting this to be plus HSD, which is high single digits. Nonetheless, previous years, they do believe they have performed very strongly. They see it slowing down a little bit, both on terms of their top line as well as their EPS growth. Now, just one thing for those that do love their dividends, we do note and we'll show you later on in the episode, they have been increasing those dividends for the last 52 years, hence they are a dividend king, and they have been increasing, in fact, over the last, as we can see here, in fact, 2010 to 2024, 7.7% year on year. So very impressive, not just dividend king, but also increasing the dividend higher than the average inflation rate in the US over the last 40 years, which was 4%. Finally, just some long-term targets, as we did go through already. What they are essentially looking for in the future is organic revenue growth in the mid-single digits, 4 to 6%, operating margin expansion 20 to 30 points, as we can see here, and the earnings per share, as we again went through, high single digits, with a yield around 3%. That is what they are looking for, so they can create that shareholder value. And currently, as we mentioned at the beginning of the episode, it does sit around 2.97, so not far off. In terms of dividend safety then, 93, very safe score. Market cap 235 billion. It is a mega cap company. Last recession, well, they did increase the dividend during the 07-09 crash. They had negative 0.5%, pretty much flat during that period, which was above the average growth of the S&P, which sat at negative 12. And they also outperformed the S&P, negative 35% recession return, with the S&P coming in at negative 55. Dividend growth, very strong. They increased it, in fact, just 2 months ago, 7.1% above the inflation target we advocate on the channel, 7% on average over the last 5 years, and double digits over the last 20. Very strong, and as we noted, they are a dividend king, as they have been increasing those dividends for more than 50 years. Now, in terms of undervaluation and dividend yield theory, it states a company is undervalued when the current yield sits above the 5-year average. Strong undervaluation signal, not just on the yield, but also the forward PE. Yield is above the 5-year average, as well as the forward PE being below the 5-year rolling of 24. And when we compare it to the consumer staples, it isn't too far off there, 20.1, Pepsi coming in at 20.7. Now, in terms of the free cash flow payout, this is something that has always really frustrated me with this company. And before we look at that, just to let you know, earnings data, it is there if you want to see it. But as always, it is susceptible to manipulation by management through accounting. Below 70% for consumer staples, if you want to be specific. Below 60%, that does give me faith that management are able to offer those double-digit increases we love to see to the dividend. 2023, 86%. Now, the reason why we do look at the free cash flow payout, if you were to look in 2022, 67%, it wouldn't bother you. What this signaled in 2022, a red flag indicator, as we would say, management paid out more in dividends than they generated in free cash flow. What's nice to note is that it is decreasing, 86%, still high for my liking in 2023. Nice to note, 2024 is expected to come down to 80% at 78%, and I personally would like to see this a lot nearer to 70% in the future. Free cash flow per share, very inconsistent. Whilst it has increased marginally over the last 10 years, it is essentially very, very inconsistent and has gone down to 387. Now, one thing to note is that in 2024, it is expected to increase just under $7. So that is positive, but do note, on a free cash flow basis, it isn't the most consistent company. Sales growth, again, pretty much driving that theme here now of inconsistency. We do note they did go through a period of pretty poor revenue increases from 2014 to 2018. But since then, looking very healthy, especially the last 5 years, as we can see here. As always, we do want to see a minimum of that 3 to 7% rate. Now, in terms of the total sales, you can see that numerically here. Shares outstanding. Now, yes, we love it when companies do share buybacks, returning that excess cash to investors. What we do know is they do share buybacks. Not a lot, not very consistently. Nonetheless, it is still returning some of that excess cash by reducing those shares and giving you a larger portion of that company. ROIC above 10% or more, just to give us that faith that management are able to effectively allocate their capital. Very strong, very consistent. I love a lot of consistency around that 20% nearly every single year over the last 10 years. So that is very attractive to investors. Now, operating margin, it does straddle around the 16% year on year. No real red flag indicator, just purely down to the basis of that consistency. And the free cash flow margin, a minimum of 7% is what we want to see. It hit that in 2022. Nice to note it has rebounded down to 9%, although we do see it decreasing over the longer term. Maybe something just to keep an eye on as the next annual report comes out. Finally, the net debt to the earnings before interest, tax, depreciation, amortization, correlating to both dividend safety as well as balance sheet strength. We want to see below 4 for consumer staples. That is the 4, the number which indicates the number of years it would take the company to pay off all of their debt net of cash on hand. 2 in 2023, 1.91 expected next year. No real worries. We can see why the balance sheet does look strong and why that dividend does look to be secure. So let's jump into the valuation of PepsiCo. As always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, jumping into the first valuation model, we have the multiples model with companies in a similar sector and size. We have the average P multiplied by the EPS of PEP to get an intrinsic value of $176, giving us our first undervaluation signal, but do understand that we don't look at any of these models in isolation. We then have the second model, the dividend discount model, with the growth rate year on year coming in at 7.26%. Very healthy, very nice to note as a dividend growth investor. 5.25% is what we have gone forward looking, more on the conservative side, and as we can see, a second signal of undervaluation with that intrinsic value of $207. We then move on to the third and final model, the DCF discounted cash flow model, with the increases year on year, latest free cash flow growth of 39%. Average at 2, forward looking, we have gone in line with analyst targets at 12%. With a discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and we can see here the intrinsic value above the market value, giving us that third and final undervaluation signal. So the intrinsic value in today's episode is purely the average of these three models, coming to $192. Do bear in mind you can grab a copy of this valuation model to get to the intrinsic value as well as the acceptable buy price of companies in your own portfolio or those on your watch list. 10% margin of safety is what we always start off with. We use that if it meets 3 golden criteria: a wide moat, strong financial metrics, and good forward-looking data. So at 10%, it is a buy up to 173. At 15%, it isn't quite there yet, not too far off at 15%. So for today's episode of PepsiCo, we do see between a 10 to 15% MOS level. That is purely based on our estimates and judgments. Now, in terms of Wall Street and their price forecast, well, over the next 12 months, they pretty much see it not too far off our intrinsic value. They see upside of 14%. As we mentioned at the beginning of the episode, they do see this as a buy now, and it does look like it has a nice upside, as well as not just collecting the dividend yield of 3%, but also some nice increases to that dividend year on year. As always, do let me know your thoughts in the comments below. Is PepsiCo one you're looking to add now? It is below $170. One that's on your watch list, waiting for it to come lower, or maybe you do believe this isn't one that is right for your own portfolio. As always, let us know if you enjoyed today's episode. Smash that like button, hit that subscribe and bell button, and as always, we'll see you all on the next one.